you IT because that's what we were discussing just before we went on break. You have a great grip of the global macro setup, and IT largely depends on that. Do you see a rebound in IT at some point in FY26? Is that something which is realistic? Because that will likely come out in the commentary tomorrow. So trying to get your sense on what you're penciling in.
Yeah, definitely. I think the worst of IT earnings are behind us, and things should improve going ahead. There is some amount of lack of visibility for the Indian IT services companies because they have been slow in terms of the AI end use offtake. I think that is what will ratchet up. If you see the last 3 quarters of earnings commentaries, a lot of the workforce is being trained on using AI, and a lot of end use caselets are being created to help companies benefit from the massive investments in AI that are happening globally. What has happened is the results have been underwhelming. There was an MIT research out last month, which showed that about 95% of companies are reporting no increase in revenues after implementing some AI solution. Same way, McKinsey came out with a research that about 8 out of 10 companies have not seen the benefits coming in right now. I think as the AI matures, you're going to see more end users coming in, and that's where things get exciting for our IT services companies. So definitely, I think the worst is behind us, and you would see a recovery next year. There is a strong correlation, as you mentioned, with the global macro. We are expecting a better growth than this year. The whole world is in an easing cycle. A monetary easing cycle is the predominant theme around the world. And next year, that benefit will also flow through in the macro. And as the macro improves, you will see more order flows for our IT services companies.
And if I were to shift focus maybe away from IT, talk broader market as well, how do you view current valuations, and how do you kind of rationalize that with the global setup as well? We've got some of the markets which have done extremely well over the last 12 months or so, while India has been absolutely flat or likely more negative than flat. So how do you rationalize that? Do you believe earnings will likely drive the re-rating going forward? And if so, how quickly does it come?
Yep. I think 3, 4 things going for us finally. One is the income tax cut, which is slowly adding more consumption power into the taxpayers' pockets. The GST cut has had a consumption impact. We will get to see the numbers by October, and we'll get a better idea of that. But definitely from the street checks, consumption has taken off post the GST cuts. That's helping. The liquidity infused by RBI and the 100 basis point rate cut, that has helped a lot. And then inflation being in a very comfortable zone, that has helped as well, along with the huge expenditure that the government has continued on infrastructure. So last year, this time around from March to September, we lost out on the momentum in infrastructure spends. By December, it started catching up. And over the last 6 to 9 months, we have seen a lot of injection of infrastructure spends coming in. Now, the festive season, we should see that benefit coming in. The government has announced a DA increase of 3%. That given the massive base of the government servants, that translates into a huge consumption stimulus that goes right into the consumer economy. So a lot of things going for us. 13 months have been underperformance, sheer underperformance. MSCI EM index has done very well. Last 12 months have been an emerging market outperformance, along with continued US exceptionalism. US markets have continued to do well, with the heavy lifting being done by the AI plays. But overall, we've had a rare occurrence where emerging markets did well and US did well, and India didn't do well. India, which is largely correlated to the US markets, we tend to rise and tend to fall with the US markets. That historical correlation got broken. So 13 months of negative returns, that is setting us up very nicely for 12 months, which should be much better. The trigger will be twofold. Any relief on the US tariff front, that will be a sentiment booster. I think that's not a direct economy booster, but except in certain labor intensive sectors where it will save some jobs or see jobs coming back. So, one is anything on the US tariff fronts, and second is the earnings returning. We were expecting that June would have been the bottom of the earnings cycle, but the GST announcement coming on August 15th and the implementation coming on 22nd September, that has meant that 40 days of discretionary spend got hit. Now, there is a catch up that has happened from 22nd September onwards, but there could be some flow through into October for it. So, the September earnings might still be muted, might be on par with June or slightly better than June, but the real kicker will come with the December earnings. So, market will not watch the September earnings so closely as the management guidance. Management guidance on what the management is seeing for the next quarter, for the next 12 months, that will really determine. And you will have very outlandish moves on good results, good guidances, and anything that is below expectation will get hit quite badly. So markets are not very optimistic. That's a very good thing. Markets are still very short, especially in the FPIs and the HNI prop books. Those are still quite short. So that's a good thing. So if there is a surprise on the upside, that should be much more than any surprise on the downside. But you don't have space to stumble because of the valuation. So valuations are much better than they were 13 months back, but still on a global scale, they are higher. So again, if you cut out some of the old economy segments and then look at valuations, there are segments which look attractive. But right now, on a passive investment, ETF flows, country fund flows, we are not getting our fair share. And that will only change either sentimentally with US tariffs or fundamentally with some amount of guidance coming in. Markets will recover before the earnings recover. That is a given. So, about 3 months before the earnings start showing an upward trajectory, markets would have started rallying. And you will get a 5, 6 months move in 2 weeks or maybe less than that. That is the big thing. So, positioning has to be positive, is what I would say.
Thank you so much,